If you decided home equity loan is not for you, there are some alternatives you can consider. First, refinance for cash. If you do a cash-out refinance, you're going to have the option to get cash from the equity in your home and a little extra as well. With this type of process, you're going to refinance your house, and you're going to add the amount of money that you're borrowing onto the mortgage. Instead of getting a traditional refinance where you'll end up with a loan that's the same total as the one you had, this mortgage is going to be larger than what you had before. You may be able to get a good amount of money without the high interest rates, if your new interest on the mortgage isn't going to go up. Apply for a credit card is another alternative. Generally, a credit card is going to be really easy, but it's also going to be really expensive. You can usually buy whatever you want with the card, and then you can pay it off over time, however you want. But you could end up with interest that's over 20%, especially if you have bad credit history, and that's going to be more expensive than any loan you'll get. If you're looking for money quickly, this might be the way to go, but if you're going to be needing that money for a few months, it may not be such a good idea. That's because you're going to have high interest, and you're going to end up paying a whole lot more in the long run. The last option is taking a personal loan. There are a couple different ways you can use personal loans, either secured or unsecured. If you have good financial standing and credit, then you may be able to get an unsecured loan, which means you just give your word that you'll pay the money back at the agreed rate and over the agreed time period. When it comes to this type of loan, you're not going to have a tax-deductible aspect, but you're likely going to be able to get a lower interest rate, which might just be worth it compared to that credit card. It might be a little higher than a home equity loan, though, which can be a bit of a drawback overall. When you get a secured loan, it means that you're giving the bank or institution some form of collateral that says you're going to keep making the payments as agreed. This might be your CDs, stocks, a boat, or a vehicle. It's generally going to mean an even lower interest rate than the secured loan. But if you default on something, you're going to lose whatever the collateral was. These loans do not offer tax-deductible features either, unless you're using the money for certain types of expenses, including home improvements. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Considering a home equity loan? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.